Good afternoon, everyone. I hope we are all awake. I don't know why they gave me the shift just after lunch. Everyone wants to fall asleep. But I'm sure you'll be kept awake by the panelists that I have. So maybe if I can just call them out to come and join me. We have Brett Simpson, who is appointed actually for Old Mutual Zimbabwe and Old Mutual Kenya. He's been around the block, so he knows quite a bit. We also have David, the ex-president, never to be president again. He's worked for a number of companies. Now he's running his own mails. He's actually outsourcing. And we also have our brand newly qualified actuary, Lorraine Maguire, the head of Actuarial in Old Mutual. And we also have Donald, I don't know his name, from African Actuarial Consultants. So essentially what we'll be discussing, I think Marjorie stole a bit of our thunder, but essentially what we'll be discussing is to do with some of the challenges that people face, that actuaries face within an African context, or when you're talking about markets that are not very as deep as you would get in some other countries like the UK or even in South Africa. So the way I chose them, David will be talking to us essentially about pensions. Donald will be talking to us about short-term insurance, Lorraine about product development, and Brett about valuations, including market-consistent embedded values.
That's right. That's so nice.
So we can start with David. I mean, what are some of the challenges that you face when you're trying, for example, just to come up with a basis in a country where bond notes are about to be introduced? How do you come up with a long-term basis?
Okay. Coming out with the valuation basis against the yearly, it's a challenge because there's no market. So there's no data, there's no information. So the next question is, how are we doing it? I will share with you my experience. It's a case of 6 actuaries working in Zimbabwe. It's real. I get a group of pensioners from from pension fund X wanting to outsource its pensioners to 4 life offices. Initially, I get the pensioners, I value them, and the administrator says, what would be the cost of outsourcing? I placed a figure of 1.1 million. Next, then the administrator now finishes me with the other information. The fund actually gave a figure of, you can take the figures, 890,000. Life Office 1 at 1.3 million. Life Office 2 at 1.2 million. Life Office 3 at 700,000. Life Office 4 at 550,000. I'm advising, so I try to first check to verify the figures given the assumptions in the reports. I could reconcile the 1.3 for Life Office 1, the assumptions as well as from the data. The same applies for Life Office 2 and Life Office 4 with 550. But I couldn't reconcile the one for Life Office 3, the 700,000 or so. And my advice was that it was my opinion that the figures of Life Office 1 and Life Office 2, the 1.2 and the 1.3 looked reasonable if you're outsourcing. Maybe because they're close to mine, but ideally, if the fund actually plays the value of some 890, you would find that the cost of outsourcing is supposed to be between the 890 and the 1.3. And my advice was Life Office 1 and Life Office 2, their figures looked reasonable. Then that was my advice. I gave the administrator my opinion. Then a month later, I checked what the trustees had agreed on. And apparently, to your surprise, to my surprise, Life Office 4 was chosen. To me now, that's the issues we are facing in Zimbabwe. The first one is that this is reality. This is our market. So I guess the point of discussions from this case study is, if markets are not deep and uncertain, can we rely on actuarial figures, and to what extent? And maybe the next question is, if you are putting a price on a commercial transaction, is this the same as valuing an asset, which is to fund the liability? And the next question maybe would be, in the absence of true traded market, can they be said that there is a unique correct market price to be associated with any given pension liability? And finally, maybe for the actuarial profession, because as you can see, if you are valuing the same pool of people, and you are getting values which are ranging from 550 to 1.3 million, how best can we achieve some consistency in our figures? I think I don't have answers, but I think these are the issues I thought maybe we could discuss.
Thanks, Terry. Doreen, are you facing the same issues in product development?
Thank you, Chair. In terms of the issues that I just wanted to raise in product development, I think obviously there are difficulties when you don't have a deep market with coming up with investment assumptions, for example. But what you also find is that even for those assets that we have in the country, we have only had a US dollar environment for maybe 6 years. So you don't have enough history for you to build credible assumptions around. And then if you've got any investment managers and you ask them to forecast for you, to give you their long-term focus, ask any two economists to give you long-term focus around equity performance, around bond markets, around cash. Now they can't, and they won't. And there was a period when nobody wanted to hazard any guess as to what will happen in the market. So when you hear that, and then in the product development space, I think the regulator is also looking to ensure that there is some consistency in the way that we price products and develop products. So, and they are also looking at whether we are being fair to our clients when we have policies that have got reviewable premiums and all those other things. So you have this great uncertainty around the assumptions you're using to price. But then you're also having a discussion around not varying premiums once the contract is born. So you start asking yourself whether they will ever be as strong if we get that regulation, something like that. Would it then be a strong long-term insurance industry? Because nobody is going to want to take that risk around guaranteeing the assumptions when you are not actually sure around the assumptions. So I think that's one of the major issues that we are dealing with at the moment. And then it's also the issue of affordability and balance. So usually actually when you're not sure, you load. You can load one time, you can load 2 times, but by the time you finish that product development, are you then going to get any customers? Because obviously it just makes the product more expensive. And therefore you become very selective around the types of products that you can develop and the types of guarantees that you are willing to do. So it just then means that our customers don't get the full product bouquet. So I think those are the main issues, but I have a lot of questions for the audience once we get to question and answer. I'm going to be asking, they're going to ask me.
Okay, before you hand it over, you don't want to be like an opposition party, we want to keep solutions. So how do people, because there are products that are being sold in the market, do you just then load and load and load, or how do you actually end up putting products out there in the market?
What we do is initially we load, but then we need to make sure that we complete the actuarial cycle. So you load, and then you review your assumptions and you see what's coming up, and then you adjust. Because, and this is where it is critical that what has enabled us to actually bring products to the market is the fact that if your assumptions are wrong, you have an opportunity to correct it. So if that opportunity is removed, then you load more. Yeah. So that's just the challenge we're facing.
Okay. So Brett, coming to you now. The company has been valued, maybe a company wants to be bought, you want to calculate the embedded value, or you want to calculate the profit earned for the year so that shareholders can get their dividends and so on and so forth. But you need assumptions. How do you do it?
Thanks, Brian. I think it links through to what David and Lorraine have been saying just before me. So if you look at the actuarial control cycle, it's really about collecting data, analyzing it, setting an assumption, and reviewing it. And in each of those stages, there's invariably tricks or complexity that comes with working in different markets. So some of the things that I've found is that working in a market like such as Zimbabwe or Kenya, is that invariably you don't have the data. And that's been mentioned before. I know James was doing a lot of good work with new mortality tables. But given that you don't have data, you also, and some of the drivers for that are invariably it's a new market, there's a move from formal to informal sector, so you've got to try and manage that and see how you can incorporate that into your data. There's also a low penetration currently of insurance products. So while that's a huge opportunity, it also comes with its associated risks. And then I know Peter laughed a bit earlier when we talked about market consistent embedded values. Well, there isn't one curve in a lot of countries. So what is the risk-free rate? And there's a sort of a tried and tested way of predicting and calculating discount rates, and invariably some of the more simple ways of doing it are you take one curve and you add risk premiums for each of the asset classes. And then you just multiply that by your expected mandate. But if you don't have a bond curve, where do you start with? And then another challenge that faces data is really the relevance of the data. So it's fine to look back and to say this is the data I have, and then the question is, can I actually use that? And that ties into, it's been raised a couple of times, is really the issue around lack of deep and liquid markets. So even looking at a price for an asset, and you don't actually know if that's really the price you could actually realize that asset at. So is the company solvent? And I'll discuss just now really ways I've thought of managing challenges. It's by no means exhaustive. But before we get there, one of the other things around the relevance of data is really what I call low frequency, high severity events. So really a step change, for example, in an economic environment. And it has the impact that Doreen mentioned, where it really says you can no longer use historic data. But you also run the risk of you need to incorporate that into your future models, otherwise you will be exposed going forward. Some of the challenges really around analyzing the data is that complex data-rich models don't work. If you don't have the data, you can't use a complex data-rich model. And so the approach I've taken is really that it's key, or judgment becomes more important. If judgment is more important, then you need to document your thinking, and that helps in a couple of ways. It helps with review. It also helps in the auditor's visit. And then sort of the, by no means exhaustive, but suggested ways of managing these challenges. I think the first thing we need to realize is that a reserve will never happen. The number we put on the balance sheet will actually, if it does happen, we're extremely lucky, but it's actually highly unlikely to ever happen. And then, if we accept that, then we need to look at ways of incorporating the business's risk appetite into setting that reserve, as well as setting solvency levels. And ways to manage those things would be setting discretionary margins. Not very popular, but can be done. And those often are used to take out the high frequency, low severity events. So that would just be fluctuations around an average that is not really well known. And then key things to do would be sensitivity analysis, scenario modeling, and then what we mentioned before is really the frequency of the review. So where you don't have lots of data, you're making calls on judgment, it's important to increase the frequency of your review.
Thanks, Rich. Just, you made an interesting comment and observation on judgment. And from what you're saying, essentially you use quite a bit of judgment. I'm just wondering, besides, just passing references to use actuarial judgment, which subject do you actually see actuarial judgment being taught?
So it's a very good question. It's mentioned. It isn't. And I think we need to put ways in place of teaching people how to use and apply judgment, because it's that higher level of thinking where the value is actually added. And the nature of the environment is that if you have a lot of data, it actually becomes easier to do a lot of work. If you have less data, the work is actually far more complicated.
I think that's very true and very instructive, especially from what you said. I think that was one of my biggest revelations within the actuarial circles, where you do your CTs and you think there's one answer. If you don't get an answer, it's wrong. But when you actually start to realize that, as you say, in your words, a reserve will never happen. So there's a range of likely and correct reserves that you can actually set. But it's not about actually coming to that right answer, because there really is no right answer. There's a range of possible right answers. Donald, short-term insurance. It's something that's relatively new in Zimbabwe. Actuaries are not traditionally liked in Zimbabwe, the short-term insurance industry. Our guest speaker is gone now. He was calling actually is very expensive and you need to become cheaper. You need to become cheaper. So what do? Now you have to do your own valuation for $2,500 and you have no data. What do you do?
Thank you very much for that, Tom. Actually, you've actually touched on one of the primary challenges that actually is faced operating in our market. Because there's this distance between you and management. And well, normally, depending on your approach, you could actually make things worse or better. Take, for example, the area of pricing. In the area of pricing, you can come up with all the math that you have, and you can look at all the data. And funny enough, when it comes to data, I don't think in general insurance that's actually a problem. It's not. You're never going to really get data for 10 years and have it being relevant at the same time, given the way the practices change and yes, companies respond to new competitive pressures and try to adjust their strategies to ensure that they are always competitive. So you always have to work with a short time span to come up with your decisions. So data is not the problem. But when you come up with a theoretical premium rate, and the decision normally comes down to, can we actually sell this rate in the open market? Because profitability of a company is determined by two aspects. Number one, it's actually having the correct price, and number two, actually securing the sale. And quite often, those two objectives do contradict. In Zimbabwe, there hasn't been that much emphasis on theoretical rates. What insurers try to outpace one another on, the way I see it, is actually ensuring that they've got a rate that can actually sell. So you might be a lone person in the room. What I think probably might need to happen is actuaries probably need to sail in the same boat, because we've had some products like, for example, if you look at property, if you look at your engineering risks, an engineering risk, say Marangi or some other diamond mining company, might be so unique that there's no real comparable for that. So what that means is you really have to be innovative. You really can't complain about the system because there's no way you're going to find a similar risk. So, because what I discovered was that non-actuaries, just your basic underwriters, do come up with a price for that transaction, and they actually do business. And yes, sometimes they do get burnt, but who's to say the actuary is always correct despite all the logics? So, so I think we need to find a way of actually fitting in. I was considering a particular example when David was talking about the annuities example. To say, if you've got like only one building, how much would you hold as a reserve for that? I think we kind of debated that question because in my mind, yes, let's start with maybe an example from life insurance. You've got your life tables, but when you come to general insurance, even within the life insurance space, if it's only one life that we're talking about, the way I look at it, the person could die or might not die. The only place where the insurance tables actually start to kick in is when I've actually got a cohort of people. That's a large number of people. Then I can talk of pulling of risks, central limit theory, and all that. That's actually where we write on. But if you've got one risk, then it's like you really need to keep half of what the actual claim is supposed to be. That's the way I look at it. But for some, it will be very excessive for the insurer. And essentially, you're saying, I can't price that. Because if you can't reserve for it, you can't price it. Yeah. So you take that same concept to general insurance. You are essentially having to guess many times. And I think we need to actually develop the art of guessing. Because I'll just, probably as the discussion develops, I'll just touch on some of the principles, because I believe the profession is actually founded on principles, which is why we've got a difference between the city subjects and the higher level subjects. The issue is actually grasping the concepts and ensuring that you are applying them appropriately. But those are some of the challenges you face. Another area that you've got a challenge is capital. On capital, you've got two desires. You want to ensure that there is sufficient capital and you are not found in the wrong should something happen, an adverse event actually develop. But at the same time, you want to ensure that the company is able to release sufficient amounts of profits at a steady pace for the satisfaction of the shareholders. But the challenge that you have is how do you actually calibrate that capital model? What is the asset risk? The tendency has been to just go into regulation from, say, Australia, the UK, other countries which have tried to be prescriptive about such capital charges, and then try to make some sort of adjustments from there. And then you can also have some other guidance. But is that enough? Is that backed up by the historical development of things? And even if it's backed up by the historical development of things, you've got no guarantees that is what is going to happen in the future. Primarily because general insurance practices are always changing. And if they change, how then do you then adjust the historical information to reflect the changes that you see? So those are some of the challenges that I see in general insurance.
Thank you. I think from what you said, I can give 2 examples. I think from my own personal experience, one of the things that actuaries just need to do, especially when it comes to pricing and Western and short-term insurance, is you need to get off our chairs. Because you want to price things you've never seen before. You've never gone to see a client before. You don't even understand. Because I used to have this, well, maybe I still do, because I still have challenges with the marketing guys. But I think when you actually go and try and sell something, and you actually understand some things from the point of view of the client, I think pricing mechanisms and loadings don't become as severe as we sometimes put them. I mean, we once worked on some pricing of a Kenyan product with Andrew there, you know. We had a very nice model. It was, it's one of those models there. Send it through for review, loading 1.8 times. Goes to the next layer of review, 1.5 times. You can't even recognize the answer you came up with. You spent 5 months coming up with this very nice model. You may as well have guessed. So I don't believe dollars, right? I mean, at some point you just guess and save everyone, the company, everyone money. But
I don't think it's guessing. we call it professional judgment.
my question, maybe which I asked Brett was, which subject do you find that in? Martin is getting upset. President.
I'm not upset, I'm just responding to that complication because judgment is not something that the CTs or the essays or whatever should teach you. What the examination system is there to do is to equip you, to allow you to know in certain circumstances what you need to consider. So you're operating in a very uncertain environment in Zimbabwe, and when you're faced with a problem, you know what you need to be thinking about. So if you're thinking about evaluation, you're going, well, you know what? No credible bond market. How am I going to work around this? The fact that he knows what he needs to be considering is exactly what the judgment is about. It comes with experience, it comes with exposure. So, personal point of view, not something you can put in a book.
I agree. My question to you, just we put enough emphasis on it when you're going through your actuarial exams.
Maybe not, but I think it's inherent in the later examinations that you're expected to demonstrate you can think more broadly than what your notes indicate. And in fact, as an examiner, that's what you give credit for. People who are considering the bigger issues and not just what the text has told you. So yeah, but while I have the mic, I want you guys to maybe position for us the view of what value for money means in a Zimbabwean context. So as a recently ex-Old Mutual employee, I know this is something that's very top of mind, but you guys are competing against folks who potentially don't have that same lens because the regulatory environment is slightly different. So perhaps the guys to the right can give a view of when you're pricing products, should your primary concern be around how fair you are to being how fair you're being to customers, or whether it should be completely commercial.
Anyone want to take that?
Before I do, there's just one thing I wanted to add. There's actually an element of professional judgment that's actually taught in the notes. If anyone remembers their general insurance notes, I trust the other subjects do teach that. that you need to consider the market. That in itself introduces the aspect of judgment. My only problem with that, when I really thought about it, was after I've done all the maths and come up with a rate, if I then have to consider the market, what is actually set the rate? Was it all my maths? Was it actually the market? Because I now have to calibrate my model to come back to the market. So I might as well have started from the market in the first place.
I don't think it gets to that extent. I think the one thing Brett said that is very important is to do with when you make a judgment, document it. So that those that come after you, auditors and all those people, they understand your way of thinking, and I think they come points whereby even when you're doing a pricing thing, you have your last rate as an actuary. You can't go below that. If they want to do anything below that, the business is well within its rights to do it, but it's not, as an actuary, you can't go below a certain rate. Because at that point, it no longer follows any actuarial principles, and it goes to your professionalism as an actuary. You must say, you know what, but this is the last rate that I can give you, and the business can then make its decision whether or not because at the end of the day, you must also know where your mandate stops. The mandate stops is giving them a rate, but if they want, like James was saying, if they want to sell it at half the price and make a loss, then it's their, at the end of the day, it's their business. But I don't know whether anyone wants to take the value for money question.
I would like to attend. On whether it should actually be purely commercial transaction or whether you need to consider other things. My take is that what actuarial science actually introduces is actually part of the commercial transaction sphere. In the sense that if there are certain risks that might actually mean that the insurance company might not be able to deliver in future on a certain transaction, then not actually pricing it is actually doing a bad commercial transaction. So I actually think the consideration of risks and all those things that probably some other people who might not know might actually ignore in a certain transaction is actually bad for that transaction, because in future what you want to do is you want to ensure that you've got a fair value. And in a fair value, both parties, if they've got full information, must be willing to accept that price, and one will hand over a certain asset and one will receive it. So I think they will not have sufficient information if they have not considered some of the actuarial risks that you're looking at. So I think we actually add value in a commercial sense, not just to say there's a way of doing business and then actuarial science is something parallel. No, it's not actually something parallel. I think it's actually a real cost of doing business, and it should be seen in the commercial context. Thank you.
I might just add that although the conversation is purely being probably actuarial before, when it comes to value for money, I see an interest from our regulator now around those issues. I think the new product development standards or guidelines that are being discussed have got a requirement to show when you've priced something what is actually going to risk, what is going to your commission, what is going to expenses, and what is going to your profit. So I think it will go a long way in ensuring that our customers are paying for the service that they think they are paying for. I think one of the challenges that we are now also seeing when we start speaking about value for money is around the issue of commission. Your clients may not think that is value for money, but they're actually getting advice and they don't believe they have to pay for that advice. Whereas if they didn't get that advice, they may not have seen the need for the product and they may not actually have selected the right product. So there are places where businesses think that they are providing value and our customers should start appreciating it, but there is probably need for some education around it, because so if you're looking for savings products, for example, somebody gives you $100, they want $100 despite having used an agent's time, which is maybe 10% of that, and having made the choice to consult. So it's just one of those things that we now need to start speaking to our clients about so that they understand the value, the total value of what they're buying and what exactly they're buying. Another thing is when you have bundled products, maybe a savings that has got an endowment type, and they have got, you've got life insurance within a savings. They still don't expect their $100, but they have been enjoying life cover. So I think the life insurance companies are doing what they can in terms of ensuring value and ensuring that you're paying for the right services, but there's probably still a gap around the understanding of what you're exactly buying and what you should pay for it.
These are obviously my own views and not those of my employer. So I think defining value is one of the first steps. And so what is value? You can sell a tin of tomato sauce in two different places that are very close to each other at very different prices, with very different markups. The risk once you start to define a hard rand or some dollar value number is that it can actually be a barrier to entry, where new entrants can't enter because the return on capital is just too low for them. But from the other side, I think being a commercial enterprise, and an insurer is supposedly a long-term commercial enterprise, they need to look at a triple bottom line. So they need to look at social integration, social responsibility, and I think that is almost a natural counterbalance to ripping people off.
Okay. Just been told we had the questions statement already. Shepard, our dear president, has a question for us.
Thank you. I think at some point, as we're discussing, I think we pointed out areas of uncertainty, which I think obviously would then push us to go the direction of putting loadings. But this issue of value for money that Temaji was talking about, I think it's important because it then challenges the process of putting on loadings on price. So if I come and ask you, I should say I'm an auditor, I think I was talking to Peter yesterday, just walk me through why you put those margins. I put 5% more, why? Because of ABC. So that we sort of like run away from the old way of doing things, that the moment there's uncertainty, if my dispensation is to have less confidence, then I'll just put on 2%. But why am I putting 2? Why not 1? And why you put a lot in the very first instance? Is it because I think there's something that's not coming out of data, or I don't have enough information, or I'm just having this likelihood of wanting to put margins even without reason? So I think value for money is quite interesting. I think I liked Brent's example, because I think much as we might do the actuarial process of getting to a price, we need to test it. So the test comes to the reality, which is, if I go to a client, what do they say about this? Do they say it's value for money? Will they buy it? And then we try and balance those. And I think in balancing those, that's when the actuarial judgment then comes. To what extent can I potentially reduce margins? Or to what extent can I potentially try and see how to make it more desirable to a client, putting more features than perhaps what the product offers and all that. So I think my point is just, I think the value for money is an important aspect that you should continue to consider, especially some aspects of treating customers fairly, the TCF principles. I think they then try and assist us to try and balance our thinking. Instead of looking at things one way, we should also look at things on the other way, so that we can try and come up with a reasonable position in terms of price or value to liabilities or assets.
Because of the value for money discussion, for me, one of the easiest ways you can borrow from Marjorie's presentation, she was talking about ethics, but it's is a similar thing, whereby if you are part of that target market, you must ask yourself, would I buy this product? If you're not part of that target market, maybe your mother is, or your relative, or your friend is, you must ask them yourself, would I recommend my friend to buy this product? And once you get an answer to that question, I think you personally are convicted whether or not the product is actually offering reasonable value for money or not. Do you have any more questions?
I think we'll take one more question and then we'll just close off.
Thank you. My question is, we work in an environment where there are so many competitive forces. Besides the competitive forces, there is the market which is shrinking. People are running out of their jobs, they cannot afford insurance products. And we are living also in a market where insurance is like a luxury per se. And there's so much of a need for innovation. And also in pricing, there's a need to take into confidence the customer that we're dealing with. So as actuaries, how best can we position ourselves so that we take into consideration the market forces, the competitive forces that are there within the market, the customer that we are dealing with. I like what is happening in Kenya. There are so many microinsurance products that are being developed, but there is not much data to talk about. For us actuaries to be able to price such products. And when they come into the market, it's either the product flops or it doesn't make money, and companies end up and investors lose money on those products. So as actuaries now, how best can we position ourselves to ensure that there is no money that is lost to the investor, and also we develop a product that is affordable and that can increase the penetration rate of insurance in our market.
In terms of innovation around products, I believe that what we see within our industry is very formalized organizations which have predominantly been able to deal with the formal markets. And my belief around why it's flopping is because we haven't gone back to really understand the needs of those people and understand what they live on and understand what they actually need to be covered for. So I think that we do not have an understanding of the market, so we try to launch the same products but only with the lower sum assured, or put in some flexibility but still require monthly premium. We actually haven't sat down to design a product for the informal market, in my view. We're just selling the same product. So some studies that I've done within the informal markets and what drives them is you get an understanding that they face so many risks on a daily basis that if you offer them funeral without their health, they may not be able to pay you tomorrow. If you offer them health without some ways insurance for whatever they are selling, they may not be able to pay your premium tomorrow. And if you're still demanding it on a monthly basis, they definitely won't be able to service that policy. So I think we just haven't done enough research and done enough design around that market.
Thank you. I think we have been called for time now.
I just wanted to add, I think pretty much all the solution basket is within the concepts of actuarial practice. Because if you look at what Lorraine was touching on, that's what you call identifying the stakeholders and defining the solution within the context of the actuarial control cycle. So we do have the principles, but maybe we're not really going deep enough to apply them so that we can crack open these volatile markets and develop products that actually make sense and have a role that is actually respected for actuaries. So I think we need, one of the things I'll just recommend is we need to do a bit more of talking to the actual players within these markets. So I would encourage all the actuaries to actually talk to the players, talk to the executives, talk to the managers, talk to the underwriters, talk to the marketers, really get to understand these markets. Thank you.
Thank you very much. Unfortunately, we can't take any more questions.
One more from Chote.
Unfortunately, we can't take any more questions. But I think what all we're trying to do was just to paint the picture of the uncertainties that are there in the environment, and not for avoidance of doubt, it's not to say that actuarial principles cannot be used, but it's to say that the reason that companies actually employ actuaries in these complex environments is because we have been equipped by our education system to actually think beyond just the numbers. And that is the desire and the ability to acquire those judgment skills is one of the things that actually, well, I wouldn't say a bad actuary, but would actually separate a good actuary and an average actuary. So thank you very much for listening and not falling asleep after lunch.